Welcome to today's webinar. We're going to get started momentarily. We're just confirming the audio. Please ask questions in the chat, and I'll be answering these questions as we go through it. If you're watching on the recording, you can ask questions in the comments. Sounds like the audio is working. I would ask you also to please like this video and please subscribe so you can get notifications of our weekly webinars. So today's topic is a very common topic that comes up, so hopefully everyone finds it useful. Again, thank you so much for joining. Please don't hesitate to ask questions in the comments as we go through it. So let's get started. So let's flip to the roadmap of where we're going here today, what we're going to talk about. So we're going to go over the differences between a Roth solo 401k and a Roth IRA, specifically focusing on the self-directed concept or types of accounts. So we're going to talk about the technical differences. We're also going to talk about just some practical considerations and scenarios as you might be thinking about doing a comparison between a Roth solo 401k and a Roth IRA. And then, of course, how to get more information about your specific situation. So we've got a number of pages here laid out in chart form to help us go through these key differences. So the starting point here is qualification. So to set up a solo 401k, whether it's a Roth solo 401k or a pre-tax solo 401k, you have to be eligible. So you have to qualify. So you don't have that same qualification requirement for a Roth IRA. To make Roth IRA contributions, you really just have to have earned income. So, and you have to be below the AGI limit. So you can't make too much money. But in order to set up a solo 401k, you have to be self-employed, meaning you're reporting self-employment income on your taxes and have no full-time W-2 employees working for you. So full-time means a W-2, not a contractor, but really a true W-2 employee who's working at least 1,000 hours a year with a year of service, or starting in 2021, based on the Secure Act, working 500 hours a year for 3 consecutive years, again, starting in year 2021 and going forward. So the next point that we want to discuss is you acting as the trustee. So with the solo 401k, the solo 401k owner, meaning you, the business owner, you can serve as the trustee and the custodian. And so that's how it works with our, self-directed solo 401k plan. You're the trustee, you're the custodian. We don't have access to your money. So for example, custodian would be if you are investing in real estate. And so the title documents, you're not going to turn those over to us. You're not going to turn those over to, say, the bank where your solo 401k bank account is at. Whereas with an IRA, as required by law, under the IRA rules, you have to have your IRA account at a financial institution or a trust company. Specifically, if you're looking to invest in alternative investments, it's going to have to be a trust company, a specialty trust company that allow you to invest in those alternative investments. Participation. So again, anyone with earned income can participate with the solo 401k. If you want to be able to make Roth solo 401k contributions, you have to have a solo 401k plan that allows you to do so. And we've got, of course, our plan does, and we've got tremendous video library out there comparing other providers that are out there. A lot of them don't, most of them really don't allow for Roth solo 401k contributions. And you really have, if you want to be able to go with Mega Backdoor Roth or be able to do voluntary after-tax contributions, it's got to be through with a plan like ours. Contribution limits, that's another really big difference. So with a Roth IRA for 2020, the limit is $6,000 or $7,000 if you're 50 or older. Whereas with a Roth solo 401k, you can contribute as a Roth solo 401k contribution $19,500 or $26,000 if you're 50 or older. Or if you have a solo 401k with us, our plan allows for Mega Backdoor Roth contributions, which would allow you to increase those Roth contributions ultimately to as much as 57 or even 63,500. So it's a huge difference between the Roth Solo 401k and a Roth IRA in terms of the contribution limits. So please don't hesitate to ask questions. We'll keep going through these slides though. So income limits, we alluded to this on the prior slide. So with the Roth Solo 401k, there's no income limits. As long as you have the self-employment compensation to justify it and subject to the contribution limits, you can contribute up to the maximum that we went over on the prior slide. In terms of a Roth IRA, however, if your AGI is too high, you are not eligible to make a Roth IRA contribution. Beneficiaries. So anyone can be your Roth IRA beneficiary. Likewise, with the Roth Solo 401k, anyone can be your beneficiary. However, if you are married, your spouse must consent if you have someone other than your spouse as the sole primary beneficiary. So as part of our establishment process, we will provide you a beneficiary election form where you can designate who your beneficiaries are. And on that form, if you choose to have someone other than your spouse as the sole primary beneficiary, then your spouse just needs to consent to it and it's notarized. That consent is notarized. Required minimum distributions. So with a Roth IRA, there is no RMD requirement, of course, while you're alive. As far as a Roth Solo 401k, you do need to start taking distributions not later than age 72. Of course, you can roll those over to a Roth IRA before the end of the year. And if you zero out your Roth Solo 401k account balance, then there's not going to be a RMD because it's calculated based off the end of the year balance. Loans. So with the Roth IRA, you are not eligible to take a loan. Like any IRA, you cannot borrow from your IRA account. Whereas with the Solo 401k, if the plan allows for it, like ours does, yes, you can take a 401k participant loan. So you can take up to 50% of the balance, not to exceed $50,000. It has to be documented. We prepare those documents within 1 business day as part of our services for no additional charge. If you are borrowing, if you have both a pre-tax, say, and a Roth account, so each loan is documented at the sub-account level, but the amount that you can borrow is calculated at the plan level. So if you take a $50,000 loan from your pre-tax Solo 401k sub-account, you're not going to be able to take another $50,000 loan from your Roth Solo 401k account. Of course, if you have another participant like a spouse, it is calculated at the participant level. So hopefully that makes sense. And we have a good question here. So please elaborate on Mega Backdoor Roth. So we can do let's go back to that since we've come to the end of this slide and touch on that. So the Mega Backdoor Roth is very popular reason that people set up accounts with us. So we are very well versed in how it works. It can be it can be an in-depth discussion if you're getting used to it. And we have a tremendous amount of webinars and information on our website about how it works. But just to give you a quick 30-second overview. So a Mega Backdoor Roth is really the industry terminology. What you are doing is taking advantage of the ability to make higher voluntary after-tax contributions. So a voluntary after-tax contribution is a different type of contribution. It's different than a Roth contribution. So a true Roth contribution is really part of the employee contribution limit. So the employee contribution limit is 100% of your self-employment compensation up to $19,500 or $26,000 if you're 50 or older. And that's aggregated across all the plans you participate in. So if you have a day job and a side job or a side business through which you have your Solo 401k, if you maximize your employee contributions to your day job, you're not going to be able to make any more employee contributions to the Solo 401k. So let's assume you don't have a day job. Let's assume you have, $26,000 of self-employment compensation, you're 50 or older. So you can make 100% of that amount as an employee contribution. You could put all of it into your Roth Solo 401k sub account, or you could put part of it or all of it into a pre-tax account. So, but above and beyond that, if you have additional self-employment compensation, let's say your let's say your business is taxed as an S corporation and you receive W-2 wages and you don't have a day job, you're under 50. Let's say your W-2 wages is $100,000 from your S corporation. So for 2020, if you wanted to maximize the money going into a Roth account, you could put in $19,500 as an employee Roth contribution, because it's 100% of your W-2 wages up to $19,500. You could not make an employer contribution because employer contributions are always pre-tax. And our assumption here is you want to maximize the money going into your Roth sub account. And then you can make the rest up to the $57,000 as a voluntary after-tax contribution. So that would go into a separate voluntary after-tax sub account. And then you could transfer it from the voluntary after-tax sub account to the Roth account, so that at the end of the day, so that'd be putting in, I guess that'd be $37,500 into the voluntary after-tax sub account, then roll it over to the Roth. So at the end of the day, you have $57,000 in your Roth account. Hopefully that gives you more detail as far as how the Mega Backdoor Roth works. So, and we've got a couple more questions coming in. So is a Roth, so thank you so much for the questions. We do appreciate it. So is a Roth Solo 401k a separate Solo 401k than a pre-tax Solo 401k? So it's not a separate plan, it's a separate sub-account. So you need to keep different types of money in separate sub-accounts. So for example, a lot of our customers, they want to open up a brokerage account, say at Fidelity or Schwab or E-Trade, et cetera, et cetera. So we prepare all the paperwork to do that, to open up a free brokerage account. So at the brokerage, there would be multiple brokerage accounts, but they're all associated with the same plan. So it's one plan, one fee, but different sub accounts. Hopefully that helps. If you're over 72 and taking RMDs yearly, but still working, can you still contribute to your Solo 401k account? Yes, you can if you have the self-employment income to justify it. But as noted, you will need to take those RMDs based on your end of year balance. Thank you for that good question. If my income is less, another question. Again, thank you so much for the questions. We appreciate all the participation. If my income is less than $63,500, I'm assuming you're 50 or older, can I contribute the max to the after-tax account? No, you cannot. So the voluntary after-tax limit is 100% of your self-employment compensation, which the definition of your self-employment compensation depends on your business, how your business is taxed. So a simple example is an S Corp. It's your W-2 wages that you get from your self-employed business taxed as an S Corp. So it's 100% of that self-employment compensation up to the overall limit, which for 2020, the overall limit is $57,000. But the overall limit for purposes of voluntary after-tax contributions doesn't go up to $63,500, even if you're 50 or older. So hopefully that helps. You have to have the income to justify it, because really the point of a 401k is for people who work to save for retirement. So you have to have earned income to be able to make a contribution. You cannot save more than you earn. So we went over this slide, so we'll keep going. So, and again, don't hesitate to ask questions. So in terms of the next slide here we're focused on distributions. So in terms of a qualified distribution, the concepts are similar, but there are some differences. So with a Roth 401k, you have to have the account for at least 5 years and then turn 59 and a half, or it could be on account of disability, or it could be, for example, if you die, right? With a Roth IRA, the ability to take a distribution, again, a qualified distribution. So just to define it, a qualified distribution means that you are able to take out money from your Roth account and not pay any taxes. So obviously that's the goal for most folks who are setting up a Roth account. So you have to have the account, the Roth IRA account, for 5 years. and you meet a triggering event. So you're 59 and a half, you have a disability, or it's used to pay certain expenses. We've got the bullet, it looks like on the wrong side of the slide here. So it should be over here. So just to be crystal clear. So there are some other certain expenses that you can pay with your Roth IRA money and not have to pay taxes or penalties. For example, first-time home buyers, that's just to highlight it. I mean, there's a little bit more detail there if you're going to go down that path. So, but that's essentially how it works. You have to have the account and you have to typically be 59 and a half. That's a typical situation. So another difference though is when the holding period starts. So with the Roth IRA, it begins January 1 of the year a contribution is made to any Roth IRA account. Whereas with the Roth Solo 401k, it's separate for each Roth Solo 401k account. So it begins on January 1 of the year contributions are made to that account. So if you do roll over a Roth Solo 401k into another account, the earlier start date applies. So hopefully that helps. Of course, as you get to that situation, we can help you analyze, we field these types of questions all the time from our customers and helping them analyze how it works for their situation. So let's talk about additional withdrawal and rollover concepts. So in terms of a Roth Solo 401k, when it comes to withdrawals, you have to meet a triggering event. So it has to be allowed by the terms of the plan. It's going to be subject to tax if it's not a qualified distribution. And just to skip down to the next line too, in terms of what the tax is, you have to take a prorated amount of the basis, your contributions, the basis, and the gains. So for example, let's say that you have $10,000 in your $10,000 in your Roth Solo 401k account. $6,000 are contributions, $4,000 are gains. So it's a 60-40 split. And then let's say you take out $1,000 and it's a non-qualified Roth distribution. So you would be paying taxes on 40% of that non-qualified distribution. So that would be the $400 you'd have to pay taxes on. So let's flip over and talk about taking a withdrawal from a Roth IRA. So there's no triggering event rule like you have with the Roth Solo 401k. So you can take it out at any time. The way that you take the money out though, skipping to the next line, is you first take out your basis. You first take out the contributions. Once you've taken all those out, then you take out the earnings. So you go in order, contributions first, then earnings. As you're taking out the contributions, that is taxable. Once you get to the earnings, I'm sorry, as you're taking out the contributions, that is not taxable. Once you get to the earnings, though, that is taxable. So hopefully that helps. Don't hesitate to ask questions, please. So rollover rules. So you cannot roll over a Roth IRA to any type of 401k because of the Roth IRA rules, including a Roth Solo 401k. So that's going to be prohibited. Whereas with the Roth Solo 401k, assuming you meet that triggering event, you could roll over the money to a Roth IRA. Recharacterization of rolled over amounts. It's absolutely not permitted to recharacterize with a Roth Solo 401k, and the ability to recharacterize Roth IRA rollovers has been limited based on the Jobs Act of 2017. We've got some more questions. So thank you so much for those good questions. So the latest question is, can I transfer an after-tax IRA to a Roth Solo 401k? So great question. So after-tax IRA funds are like Roth IRA funds. They cannot be rolled over. You can't roll it over to a Roth Solo 401k. Another good question, does your plan allow for in-service distributions resulting in a rollover from a Roth Solo 401k to a Roth IRA? Yes, it does allow for those in-service distributions. You do need to meet the triggering event, but assuming you do, then you could do that. And we would prepare the required 1099-R tax reporting for that rollover. So a common situation there would be somebody who's coming up to they're 72 or above, and they are trying to zero out their account to avoid taking an RMD. So thanks again for the great question. So in terms of the next slide here, and then we'll get to some practical considerations, alternative investments. So with our Roth Solo 401k, you can absolutely invest in alternative investments. That's one of the most common reasons people set up accounts with us. So you have to have a plan that, with a company like us, that allows for that. So alternative investment examples are going to be things like real estate, notes, cryptocurrency, etc. With a Roth IRA, you need to have the IRA at a specialty trust company or custodian. For example, you cannot just go to Fidelity or Schwab or Vanguard and open up a Roth IRA and start investing in real estate. They don't allow for that. If you want to have checkbook control, that's going to come automatically with our plan. So we would help you, we would prepare the paperwork to get you set up with an account at a brokerage that's going to give you a checkbook, like say a Fidelity or a Schwab, or a bank account where you're going to have a checking account and have that checkbook access. Whereas with a Roth IRA, you need to invest via a Roth IRA LLC. So your Roth IRA would own an LLC. So the LLC, the member of the LLC is the IRA, and you're the manager. So that's how you get the checkbook control, because you open up an account at a bank in the name of the LLC. UBIT exception for income from debt finance real estate. That's another big difference. So if you are investing in real estate, you may want to use a lot of our clients use debt. So it has to be a special kind of debt called non-recourse financing. And so income that is earned on that investment is, if you were to make that investment in a Roth IRA, it's going to be subject to unrelated debt financed income tax, UDFI, sometimes called UBIT. Whereas if you make the same investment through your Roth Solo 401k, there's an exception for income that derives from real estate that was acquired with non-recourse financing and held inside of a solo 401k, because that's going to be a pretty big difference there. We've got some more questions here, so let's tackle these questions before we go on to our practical considerations. So I'm going to contribute $36,450 to my solo 401k for my S corporation business. Is my Mega Backdoor Roth contribution the 57,000 less 36,450? So great question. So it's going to depend. I'm not sure what type of contribution, or how the $36,450, is that a pre-tax contribution? Is that an employee contribution? It's hard to tell. So let's say that the $36,450 consists of your employer contribution, which is a pre-tax contribution. Let's say it consists of your employee contribution. Let's just assume you're making it as a pre-tax contribution. So if you have the self-employment income to justify it, so in other words, your self-employment compensation is at least $57,000, then you could contribute the difference between what you contributed to the pre-tax account as an employee and employer. You could make that as an involuntary after-tax contribution. Assuming you have a solo 401k plan like ours that allows you to do so, you've got to put it into a separate sub account. And then when you transfer it over to the Roth account, that's going to be a reportable event. So you want to make sure that the provider is going to be issued a 1099-R like we do as part of our services for no additional charge. Another follow-up question here: can your voluntary after-tax contributions be converted to a Roth IRA outside the 401k instead of the Roth Solo 401k? Great question. So, and again, I would encourage you to take a look at the Mega Backdoor Roth. We really go in videos and information on our website. We go in very much in depth, but the answer is yes, you can do that, because there's no triggering event that you have to meet in order to transfer out voluntary after-tax contributions. So you can transfer those out to the Roth IRA. It is going to be reportable. So again, another, a 1099-R is going to be required, just like if you were transferring into the Roth Solo 401k. And we would handle that 1099-R reporting as part of our services for no additional charge. So please don't hesitate to ask more questions. We'll start to go through some of these practical considerations and scenarios to help you think through some of the differences. So am I self-employed? Do I have full-time employees in my business? So just to highlight that in order to set up a solo 401k, you have to be self-employed, meaning you're reporting self-employment income on your taxes and not have any full-time W-2 employees working for you. Whereas with a Roth IRA, there's no self-employment requirement. And on the flip side, you could actually have your own self-employed business, but let's say you've got full-time employees, and so that precludes you from setting up a solo 401k. You could still set up a Roth IRA. So those are the couple points there on this slide. Do I want to make high contributions? So as we talked about before, with the Roth solo 401k contribution limits are much higher. And as we've been going through these great questions from everyone that's taken the time to watch, we appreciate the questions. With the Mega Backdoor Roth, you can really maximize the money going into your Roth solo 401k account each year. Whereas with the Roth IRA, it's going to be a much lower amount. Will I need money before I retire? So with the Roth solo 401k, when you take the money out, you're going to pay taxes on the gains. Remember, it's prorated. On the flip side, though, you could take a loan. So maybe that will meet your needs, right? Where you can take a loan of up to 50% of the balance, not to exceed $50,000. Whereas with the Roth IRA, you could take out the basis. There's no taxes on those contributions. However, the loan is not allowed. So that there's, depending on your situation, one might be preferable. I mean, you might say, hey, I'm eligible to do the solo 401k. I want to make a lot more contributions. I still can access the money via the loan if I really need it. And we've got a question here before we go into another practical consideration. Can I contribute the max to a Roth and the max to the Roth solo 401k? So I assume by your first reference to Roth, I'm assuming you mean a Roth IRA. So the answer is yes, assuming that your AGI is not too high. And assuming that you have the self-employment income to justify, assuming you're eligible to set up a solo, you got the self-employment income to justify making the max Roth solo 401k contribution. So yes, you can contribute to both. Back to the practical considerations. Am I 72 years of age or older? So with a Roth solo 401k, there's an RMD requirement. Like we talked about before, though, you could always roll it over to a Roth IRA. With the Roth IRA, however, there is no RMD. So that could be a big difference for you. Do I want to invest in alternative investments? So there's a number of advantages of doing it through a Roth solo 401k, the direct checkbook control. Of course, you have to have a solo 401k provider that allows for the alternative investments that you want to make, whether that's real estate or notes or cryptocurrency or private placements, just to name a few. Whereas with a Roth IRA, you've got to go to a specialty provider. And if you want to have the checkbook control, you'll need the Roth IRA LLC. And then, of course, the UBIT or really unrelated debt finance income tax differences can be very big if you're looking to invest in debt finance real estate investments. We've got another webinar on UDFI and UBIT with an expert. It's really a podcast with an expert. So check that out on our website if you want to go deeper on that topic. Okay, great. Well, I appreciate everyone joining. We've got more time if you want to ask more questions. I'll just highlight that you can contact us at business@mysolo401k.net. Call us at 1-800-489-7571. Please like the video. Please subscribe for more videos like this. If you're watching on a recording, you can ask questions in the comments. Thank you so much for taking the time to join, and thank you so much for all the great questions. I don't know, we'll see if any more come in here. Okay, it looks like that's it. So thanks so much, everybody. Take care.